Over the last year, the S&P as a whole has had some very strong double-digit returns, and when we take a look specifically at the healthcare industry, we have seen some positivity, although not as strong, with Eli Lilly up nearly 10%, and there are probably no surprises that still on a forward valuation, companies are looking at some very significant valuations above their historical averages. Now, looking at companies in the healthcare industry, whilst we do see quite a lot of green, Eli Lilly, which you could argue is a fast grower, does sit at 29, but our focus is going to be on one that we believe has a lot of opportunity in the market right now, is a high quality company, lots of upside, and we're very excited to discuss. That is Novo Nordisk, down around 44% over the last year. And they're essentially a Danish pharma company. They specialize in diabetes care, obesity treatments, and other chronic diseases. And they're trading at a new 52-week low. They're more than 50% down from their all-time highs. And both Wall Street and Seeking Alpha consider this company a buy. On top of that, they're trading with a yield on offer at 3%, a forward valuation which we believe is a still around the 18 mark. And over the last 10 years, even after the drop they've had, they've still outperformed the S&P up 166%. Now, when you're investing in this industry, you need to understand there will be a lot of volatility given that the market does react on a lot of news that comes out. Just in December, the company's share dropped around 20%, and that was because they had some disappointing trial results. Now, we can show you they in fact missed by just a few percentage points. The market wanted to see around 25% in one of their new drugs, and the actual reduction was only around 23%. And then we can see a few weeks later, the shares were up on some early stage weight loss, which analysts were impressed with, but this is something that does continue to take place, not just with Novo Nordisk, but also others in the pharma space. And they recently had one of their new obesity drugs, CagriSema, get investors very excited, but again, we did see them come in slightly under than what the market wanted. So that is just a bit of a heads up before we talk about the company. You need to understand it will be very volatile depending on certain news that really, when we come to show you, doesn't affect how much of a high quality company this is. And they're also the second largest pharma company. We'll do some slight comparisons against Eli Lilly, but as we can see, significantly above third place Johnson & Johnson and not that far off number one. We also had some breaking news today that they are looking to scoop up a Chinese obesity drug, that is to put them in competition with Eli Lilly, but these are things that whilst we do like to take note of, we should also understand the fundamentals of the company and whether or not they can sustain their valuation, the share price growth that we want to see, and the intrinsic price as to what the company should be trading at today. The other thing we want to flag is that they were actually Europe's most valuable company. They have now been dethroned by SAP, but as we said, this could be an incredible opportunity, and we're going to dive straight into the number one reason why it looks massively undervalued just in relation to the last 5 years. As we saw earlier on, many companies trading at ridiculous valuations. Novo Nordisk, 18.6 on a forward P. Over the last 5 years, this is sat around 30.4. That is what we would call as one severe undervaluation signal. This is the lowest that has been offered to investors over the last 5 years, and the same message to be shown here because dividend yield theory tells us a company is undervalued when the current yield sits above the 5-year average. 2.22, not only well above 1.41, but again the highest yield that has been on offer to investors, so a double severe undervaluation signal. And then when we look at this other method, although bear in mind we're not looking at any of these models in isolation, we are going to run it through our own DCF model shortly, but what this points out is the current trading price is significantly below the blue tunnel being the expected fair value, so massive disparity here, a massive severe undervaluation signal. And great to see over the last year, the blue tunnel has been increasing. That is what we ultimately want to see from any company we're invested in, growth over the longer term. Now, they do still get a D- on the valuation grade. That is because they're trading at a premium to the sector by around 8 to 9%. But as we flagged just minutes ago, they're trading around 41% lower than what they have historically, and maybe you'll get to a slightly different valuation conclusion depending on which metric you use. For example, if you actually look at it on an EV to EBIT basis, whether trading 12 month or forward looking, they are trading at a discount, and the same to be said on a PEG non-GAAP forward basis. So slightly different conclusions. However, we would say, and we are going to show you, this company looks to be a possible steal at today's price. Now, just showing you their most recent quarter, their revenue was up 30% on a year-on-year comparison. We're seeing their main driver being obesity care at 91%. Now, that is very strong. However, again, analysts did punish them because they wanted to see a little bit higher, and we noticed some small efficiencies with a 2 percentage point increase to their operating profit in Q4. We can also compare that to Eli Lilly, for example, where their revenue was up slightly higher, 45% year on year, and we can also note some very large efficiencies. Gross profit up 1 percentage point, operating up 13, and their bottom line also up 9 percentage points. But our main issue, we're not going to get too much in the detail with Eli Lilly, but as we highlighted, Eli Lilly is around a valuation of 28.29. Novo Nordisk, which we do believe is still as good of a company, still as high quality, trading at a much lower and what we would say a potential bargain in the market. And we can also see in terms of the GLP-1, which has been one of the major drivers for these companies, Novo Nordisk as well as Eli Lilly, the main key takeaway here is that Novo Nordisk does have this slight edge in terms of the market share, and they also anticipate the next 4 quarters all to be double-digit growth. That is very strong, and we can see over the last 4, they have outperformed on 3 of them, 75% track record, 4 for the EPS estimated by the end of the year, as we said, a forward valuation at 18.4. We'll also flag that institutional ownership at 12% does in fact see that 4 billion of shares have been sold over the last year, but around 50% more in terms of the buyers at 6.5 billion, and the same to be reflected in Q4. Institutions have been buying more shares than they have been selling, so clearly at the moment they are very bullish on Novo Nordisk. We'll also just run through some of the metrics which we do want to say is very high quality. Firstly, dividend safety score 99, very safe, the highest score obtainable. They've increased the dividend over the last full year at 19%. This is something that we do see on quite a continuous basis from the company, and dividend safety was just reaffirmed last month in fact, which means a dividend cut for Novo Nordisk is highly unlikely. Now, in terms of some key metrics, this is from the 07-09 Great Recession. They increased the dividend, they didn't cut it, they didn't maintain it like we've seen from many companies during the period. They had plus 6% recession sales, well above the average of the S&P, which was negative 12, and they massively outperformed the S&P, negative 27%, when the S&P itself returned negative 55. On top of that, as we've just highlighted, very nice increase over the last year, but over both the last 5 and the last 20 years, they have continued to increase the dividend at a very attractive rate. And in fact, they've been increasing those dividends for the last 28 years, making them a dividend aristocrat. That is a company that has been increasing those dividends consecutively over the last 25 years. Now, getting straight to the first metric, we have the free cash flow payout. As always, free cash flow over earnings, something we draw your attention to on this channel, as earnings is susceptible to manipulation by management through accounting. Below 60% is what we want to see. Main reason we use this gives us faith they can continue to offer double-digit increases, and while 73%, a little bit too high than what we wanted in 2024, it's great to see the anticipation that it will come down to 58% over the next year. In terms of free cash flow per share, we want consistent increases over the period, and we do notice that $6.20 in 2015, $15.60 in 2024, that's pretty much tripled over the last 10. Yes, some years we do see it a little bit flat, but when we zoom out, we're seeing growth, and that is also expected to continue over the next 12 months to $19.20. In terms of looking at sales growth, well, this is a company that is a little bit inconsistent, but at least from 2021, they have been growing their top line at a double-digit rate, the most recent year sitting at 25%. And if we do zoom out, in fact, we can see they've nearly tripled their top line from 108 billion in 2015 to 290 in 2024. On top of that, shares outstanding has been reducing. The company has been returning excess cash to investor pockets through those share buybacks, 5.16 in 2015, 4.46 on a trailing 12 month. That is always great to see. Remember, the company also offers a very attractive starting dividend, and also one that does increase the rate at a double digit. ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital. This is one of the best we have seen on the channel. Yes, it is decreasing, but 56% is still very, very strong for the most recent year. And in terms of margins, not only are they above the minimums we want to see, 12% on the operating side and 5% on the free cash flow, but we do notice efficiencies. Not only revenue is increasing, but also operating margin going from 43% to 48%, and this is typically one criteria for us to say that a company is of a high quality. Free cash flow also very strong. You could call this a free cash flow machine. In terms of the final metric, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, below 3 is what we want to see. You see the numbers below reflect the number of years it would take the company to pay off all of their debt net of cash on hand, correlating to dividend safety, balance sheet strength, 0.5 on a trailing 12 month, 0.41 over the next year, and as we will come to show you, balance sheet does look very strong, and as we also pointed out, dividend safety looking good at 99. In terms of the growth grade, they do get an A-. Now year on year and forward looking over the next 12 months, double digit rate, 25-21% respectively, well above the sector in the mid to high single digit at 7%, but also above their own 5-year at 18 and 15%, and in terms of EPS, 24%, sector sitting at 10.8, and their own 5-year low at 14.4. So we're already noticing the company is producing better metrics, growing revenue at a faster rate, growing earnings per share at a faster rate, yet they're actually valued at significantly lower by around 40% than what they have been historically. And the same goes for the profitability. A+, gross margin 80%, above the sector at 60, above their own 5-year at 84. Bottom line, 35%, sector losing money, -4%, their own 5-year a little bit lower at 34%, and they're also generating more cash from operations, 16.8 billion, well above their 5-year of 11.25, and well above the sector, which is burning through cash, -13 million. Now we can't get away from the fact that over the last year they are the worst performing from this bunch of companies, -44%. In fact, only 2 of the 6, including NVO, have returned negatively over the year. When we expand this to over the last 5 years, the results actually flip, NVO outperforming up 177%, and when we go even further, over the last 10 years up 222. So it has performed fairly strongly when you do zoom out, but there's no denying over the last year has been one of, if not the most challenging years for the company. Now we'll also highlight that against the S&P, where it's down -43%, S&P in the same period up 11%. Over the last 5 years, it does flip, NVO up 178, S&P 133, and over the last 10 years, as we said at the beginning of the episode, massive outperformance, up 226%, the S&P up 180. As always though, do bear in mind, past performance is not an indicator of the future. They could perform a lot better. In fact, they could continue that downtrend for quite some time. And we'll also just flag that top line revenue, as already highlighted, it has grown very strongly. In fact, it's nearly tripled from 2015 16 billion to now sitting at 41 in 2024. But we also want to identify the bottom line net income. What is the story to be told? Is it of consistency in relation to the revenue? And the answer is pretty much yes. In fact, it's gone from 5 billion, nearly tripled again, to around 14 billion. So just like revenue increasing nearly threefold, that is also reflective on the bottom line, which is a very good sign. Not something you would see every single time with a company, which may come as a bit of a surprise. And we'll just highlight the health of the company, total cash versus total debt. We in fact notice cash has been fairly inconsistent, 3 billion in 2015, latest quarter around 3.7, so not much movement, but as always, one number here in pure isolation will not give anything away, so we compare it to their total debt numerically and directionally, which as we can see has actually been increasing over the period, going from 156 million to now sitting at 14 billion. Definitely something we would say to keep an eye on, but as we saw earlier, net debt to EBITDA looks good, dividend safety looks good, but as always, something just to take note of. Now, it's always important to take a look at investor presentations for the companies you want to buy. Have a quick look, see if there's any information you can see, but one thing we want to point out, their sales has been growing by around 26%. We're seeing a large driver of this being the GLP-1 diabetes, which is up 22%, but also the obesity care up 57%. And what's even more impressive, even the other income streams, insulin and the rare diseases, they're both up. In fact, rare diseases nearly double digit. So you could say top line is still growing very rapidly. And for the GLP-1, they've actually almost tripled their outreach. In fact, 2021, they had around 58% of the market. This now sits at 63%. And they've actually been taking this away from Eli Lilly, which was 38% a few years ago. And now that just sits at 34%. And we can also see this in terms of the other income streams as well. The diabetes, GLP-1, as well as the insulin. Now, as we saw, their new obesity drug, CagriSema, demonstrated around 23% weight loss. It was one that analysts were very excited about in terms of the company moving forwards, growing their income stream, but actually they were disappointed. As we've highlighted, if a company like NVO brings out a new drug and it just misses what forecasters wanted by just a few percentage points, it will affect the overall share price, at least in the shorter term, but we need to look at the wider, longer term impact, and as we have seen, they have outperformed the S&P, and we don't anticipate 1 or 2 percentage points here or there to really affect their long-term performance. And we can see here, continuing the development of a portfolio of treatment solutions for obesity, CagriSema, like a few others, are in the phase 3, and they also have some other ones which we do believe, again, will really help propel their top line at that double-digit rate we have come accustomed to. And for those that just want to see the headlines for the full year performance, sales up 25%. We do also notice this reflected on their operating profit, and also their bottom line up 21%, as well as EPS, so very strong all in all. And one thing I always like to see with companies I'm considering to buy is their capital allocation. How are they also returning excess cash to investor pockets? And we can see in the most recent year there was a split between the dividend and the share repurchase, and we can also notice this does vary year on year. And whilst there is no expectation in 2025 in terms of share buybacks, we do believe, given the share price has suffered quite a lot, they might take this as an opportunity to buy back quite aggressively, given how attractive the price does look. And finally, the expectation for 2025, top line growth between 16 to 24% and operating growth around 19 to 27%. Now, just before we jump into our own valuation, we want to let you know we have released our latest free weekly article. We draw on every single Monday morning, covering severely undervalued stocks as well as what's gone on the market over the last few days. So click below and you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can grab a recently released copy of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. And in next week's edition, we are going to be sending across a free spreadsheet running through all of the dividend kings and lots of information on every single one. So don't forget to sign up and expect that copy first thing Monday morning. Now, our valuation for Novo Nordisk does arrive at $101, derived from the DCF model. Now, you can in fact see we have the free cash flow year on year. Average growth has been 10%. We've gone moving forwards at 14%, although as you can see, we have a low, medium and high, 12, 14, 16 respectively, and the numbers are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for NVO or any others. But 14% with a discount rate gives us the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, 101 indicating 40% upside. Now, we'll also show you full transparency for those that believe 12% to be the most appropriate rate. Still $87 indicating 21% upside, and at 16% for those that are a lot more optimistic about the future, 116 indicating 61%. As typical on the channel though, we do take through the medium rate, where we're not just done there because we like to add an MOS. 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that in today's episode, a buy at $91, then we keep going till it's near the current trading price, And what we're effectively saying is if you can get this around $71, you're getting a 30% MOS, with Wall Street themselves calling this one of the best buying opportunities in the market right now. They see $112 over the next year. That in turn translates to 56% upside. Now we also want to show you, for those that believe 14% way too high, that at 12% you will still also get a margin of safety, and starting off at 10% it would be a buy at $79. At 20%, not quite there yet, but not far off. If you can get it around $70, you are getting a 20% MOS with that 12% growth expectation, and still Wall Street's price target is untouched, $112 1 year's time, translating to 56% upside. As always though, give us your thoughts. Is NVO right now a buy, hold or sell? Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells, and as always, have a great day. We'll see you all on the next one.